Hi, my name is Sergey and I'm an ex-VTB and Goldman Sachs banker. In this series of videos, we'll be analyzing a software as a service startup. We'll begin by building an operating model from scratch. So we'll create the income statement, balance sheet, and cash flow statement, and finally link them together. Next, we'll be making three statement projections, modeling our business into the future. Last but not least, we'll calculate the free cash flows, determine the relevant discount rate, and build the DCF model. Finally, we'll get to our equity value from enterprise value by making all the relevant adjustments. So let's get started. So we'll start by calculating total revenue first. So our units will be thousands of dollars. So our revenue is basically the split of total customers and their dynamics, and it's driven by average yearly customer value, how much average customer pays us each year. So let's make the split of total customers. So here you go. We'll begin by filling in the existing and new customer numbers. Here, I'm assuming that I will be making these numbers up, keeping in mind the company like Trello. Idea here is to learn to build your model from scratch. So you can take these numbers from any financials you want or you have, or alternatively you can insert what you think is relevant for your company. Let's make up the numbers. Let's assume that we have these dynamics. So it would be, let's say 980 and 280. Okay. So let's calculate the total number of customers. It's obviously easy. It would be the sum of existing customers and new customers each year. Next, we'll have to calculate the dynamics. So here, for the first year, dynamics is obviously not available. Okay, so for next year, the customer growth rate would be the number of new customers divided by the total number of customers previous year. So here you go. It's 70 and 26. Alright, so the churn, how much customers we lose each year. So it's obviously relatively easy as well. So it would be 1 minus existing customers for this year and divided by number of customers previous year. So 10% and 8%. Brilliant. So now let's assume as well the average yearly customer value. We'll measure it in dollars and of course the dynamics. Customer value growth rate. Here you go, the percentages. Again, making these numbers up, you can insert what you think is relevant. So let's assume that the company collects around $2,000 per year, and basically it just grows the average tickets by let's calculate which amount. So it's by 5%. Brilliant. So let's now calculate the total revenue. Basically, it would be total number of customers multiplied by average yearly customer value. And let's divide it by thousands, since the unit are thousand here. So here you go. And of course, let's calculate the dynamics. Revenue growth rate. So not available for the first year, and then it's so pretty well. The company is growing its revenue by 12% the second year after incorporation, and this third year the growth accelerates 2 times at now 24%. So it seems like a pretty good assumption. Next, we will what we need is to calculate the cost of goods sold. So here you are. Cost of goods sold. We'll measure it by thousands, and of course we will calculate cost of goods sold as a percentage of revenue. The percentage, and also let's calculate annual margin improvement, also in percentage. So calculating the cost of goods sold. So the split I suggest would be the professional services per customer, for instance the implementation, etc. So then we have the customer support and hosting expenses. Let's get down to the details. So professional services per customer. We'll measure it in dollars. So let's assume it's $200. And here we are. Okay. All our assumptions are highlighted in blue, so you see the logic of the model and can properly track what is inserted and what is hard-coded numbers and what is calculated numbers. The calculated numbers are in black. So you see all the hard-coded numbers are in blue, so that you can properly track the logic of the model. We will continue to do that, and all the numbers that we will hard-code and assume will be marked in and highlighted in blue, and all the other numbers, so basically the calculated cells, will be in black. So perfect. We have the professional services per customer and professional services growth rate. Here you go. So it will be in percentage. For the first year, frankly speaking, it's not available. And next, let's calculate the growth rate. Here you go. Perfect. Next, what we have is customer support. Again, let's make it per customer. Let's track it per customer. So in dollars, and then percentage customer support growth rate. Percentage, super. Let's assume it takes us $150 and we are gradually able to decrease this expense. So first year, the dynamics not available. Next, as usual. So we are able to, yeah, seems good. So next, hosting expenses. Again, per customer. And of course, the dynamics. I will copy these across. So let's assume it's $100. Then we are able to optimize our code so it consumes less storage and less hosting services to implement. So the dynamics is also not bad. Okay, so what we have next is research and development. Research and development. Let's copy the formatting. Control Alt V and T. Here you go. Oh, we have not summed up the cost of goods sold. So let's calculate the cost of goods sold first. So it is professional services per customer, it's customer growth per customer, and hosting expenses per customer. So we will need to multiply it by the total number of customers and delete by 1000 because we're measuring it in thousands. Super. So here you go. It's great. And annual margin improvement. So we're looking at how our margin is improving each year. And here we're calculating percentage of cost of revenue. So here you go. Super. So we calculated the cost of goods sold as percentage of revenue, and seeing the dynamics here, how we are basically able to improve the rate. So let's switch to research and development. So what we have here is we'll be measuring it in thousands of dollars as well. And we will of course calculate the R&D as percentage of revenue. Here there is an important question whether we capitalize our R&D or not, since we are a technology business, but it's a separate issue. We'll discuss it later. Here we are trying to keep everything simple, so let's insert the numbers. Let's assume we are each year we are spending this amount of dollars on research and development. So it's hard-coded numbers, so I would like to remind you that we of course need to highlight it in blue. Since I'm modeling on my Mac, I have to manually highlight it since the shortcut is not available, but if you are using your Mac on Windows, it would be much faster if you use the shortcuts for highlighting your cells. R&D as percentage of revenue, let's calculate that. Here you go, 20, so around 20%. Yeah, seems nice. Okay, let's move to sales and marketing. Again, let's keep this formatting. Control C, Control Alt V, T. Super. So, sale and marketing. Measuring also in $1,000. Basically, here the split would be very simple. We'll calculate the sales and marketing per existing customer and measure it in dollars, and calculate, of course, the growth rate in sales and marketing per existing customer and measure it in percentage. And there would be also sales and marketing expenses per new customers. So per new customer, and let's measure the growth rate here. So growth rate in sales and marketing per new customer. Again, let's keep the unit measurements here. Okay, so let's assume we are spending $10 to $12 on each existing customer. For new customer, the cost per acquisition will be much higher, so let's assume it is 140, 165, and finally it's 207, since it begins to be much more difficult for us to attract new customers. So let's calculate the dynamics, of course. Here you go, our dynamics. Oh no, what's wrong with it? Okay, so let's copy this across. Here you go. Now it works perfect. All right. So let's move on to, let's calculate the total expense, of course. So what we need is we need to multiply sales and marketing expense per existing customer multiplied by number of existing customers. Then we will have to add sales and marketing expense per new customer multiplied by number of new customers each year and divided by 1000. So here you go. Obviously the numbers, I've just looked at the numbers, they look pretty small, so let's increase them. Let's make them around 100 here, 103 here, and 106 here. So per new customer, it should be much more, because here we are attracting, frankly speaking, the B2B customers, so businesses, and it should be a higher cost per acquisition, of course. So let's make it more realistic. So okay, now we are looking to model the general and administrative expense. So let's start. General and administrative. Of course, let's keep the formatting. Control C, Control Alt V. Oh no, what's going wrong? So it's Control C, then Control Alt V T. So the formats are here. It's again in thousands. So we'll split our general and administrative into fixed expenses and variable expenses. We'll not dig into detail on how to properly calculate, how to allocate fixed expenses, how to dig it from first principles and variable expenses. We'll just insert the numbers, the arbitrary numbers that we think are relevant here. So general and administrative, so fixed expenses and growth rate in G&A, fixed expenses. It's really critical to calculate these growth rates since we will be next building our projections, and these growth rates would be our base to see how the dynamics works here in this company, and so that we are able to make the relevant projections. So it's really important from the operational perspective to calculate these growth rates. So G&A here, variable expenses, and growth rate. No, here we will not be measuring the growth rate in variable expenses since they are variable. So what we care about is the percentage of revenue. It's X. So let's calculate that. So variable expenses as percentage of revenue. Super. So measurement units. It would be thousands of dollars. It would be percentages again, and let's copy this here. Super. So let's make our assumptions. So let's assume that since it's the technology business, it doesn't take us much to build the software we are selling. So our fixed expenses should be relatively small here. Variable expenses, let's assume that they are much larger. So here you go, and calculate how much it takes us as a percentage of revenue. Total revenue, super. Around 7%. Sounds great. And of course, let's look at other assumptions that we need for our income statement. Here you go. So it's other. We'll measure it. Okay. So we will have to assume what interest we are earning on our cash. So let's make it 4% on our dollars in cash. And as for the effective tax rate, let's assume 20%. Here you go. So now it's pretty straightforward here. So what we've done here is we've started with the top line, the revenue. We calculated it from total number of customers and then assumed our average yearly customer value. Assume the dynamics here. Then we're moving here to expenses. We've calculated cost of goods sold so that we are able to arrive at gross margin. Then operating expenses. It's research and development, sales and marketing, and general and administrative. And also we've made an assumptions for our interest on cash that we are earning and effective tax rate. So those are pretty all the assumptions that we need for our income statement. Now let's move to the balance sheet and make the same. So as we finalize our income statement assumptions, let's move on to balance sheet assumptions. And we'll begin with operating assets. So operating assets is obviously accounts receivable, inventory, and prepaid expenses. So we'll be driving accounts receivable as percentage of revenue. Then we have inventory, and we're driving it as percentage of cost of goods sold, obviously. And we have prepaid expenses, and we're driving it as percentage of operating expenses, as OPEX. So units here are similar. It's thousands of dollars. Here you go. For now, we're just leaving it empty, since we will calculate these ratios once we have filled in the balance sheet. So we'll be filling in the balance sheet with the numbers either you have on your own based on the actual performance of your startup, or if you're analyzing the company, you can take it from the historical financials. So let's move on to operating liabilities. So operating liabilities. It's accounts payable, accrued expenses, which is very similar to accounts payable for a few small differences, and deferred revenue. So accounts payable as percentage of operating expenses, then accrued expenses exactly the same as percentage of operating expenses, and deferred revenue obviously as percentage of revenue. Again, leaving it as it is. We'll calculate the ratios later. So next we have to create a capex, capital expenditure, and depreciation schedule. So let's begin with that. So it's capex and depreciation schedule. So it's very simple. First of all, we will have to assume our useful life of new property, plants, and equipment. So useful life of new, that is caps lock, useful life of new property, plants, and equipment. Here you go. It's basically number of years, and let's assume it's 7. If you're analyzing the actual company, you can take this information from notes, or sometimes the company just indicates this on its balance sheet in the reference notes. So calculating next the total existing net PP and E, property, plants, and equipment, in thousands of dollars. So it consists of annual capex, or annual investments in property, plants, equipment, and annual depreciation. So let's begin with annual capex. It's again thousands of dollars. Here you go. So let's assume that for the first year it was 60, then it was 70, then 82. Here you go. Then we will calculate capex as percentage of revenue. Very simple in percentage terms. Then making it as percentage of revenue. So it's around 3%. And we want also to see how our annual capex investments grow. So it's annual growth, percentage, here you go, again percentage. So very simple, calculating. So for the first year it's not available, but for next it's relatively straightforward. So it's around 70% growth in investments in capex. So it's quite good, quite good. So next we are creating an annual depreciation schedule. We'll be measuring it in thousands of dollars. Here you go. So what we need is to create the breakdown, the split of how we are depreciating each new investment in PP&E. So let's do it. So depreciation full year 15, new, then it would be 16 and 17. So 16 and 17. So very easy. So here you go. For the first year, it's straightforward. We are just taking the transpose, taking annual capex, dividing by the useful life, and here you go, it's 9. Then selecting the next two rows, again transpose, then choosing the array, then dividing by the useful life, and since I'm using this array function, I will have to press Ctrl Shift Enter instead of Enter this time. And of course, selecting these three, again transpose, selecting all the annual capex for 3 years, then divided by number of years, Ctrl Shift Enter, here you go. So our annual depreciation will be obviously the sum of those allocations. So here you go, and now finally we're able to calculate our total existing net PP&E. Frankly speaking, it's our beginning number plus investment in this year and our yearly annual depreciation. So let's create to illustrate that. Okay, 1 second. So to illustrate perfectly that we did have zero here, zero investment here, and it was the beginning of 15. So we are assuming that our startup was founded in the beginning of 2015, and obviously we had zero investment in capex this year. So let's move to total existing net PP&E. So it's obviously the previous investments plus current investments minus annual depreciation. So it's 51. It's oh no, here you go. So we'll have to make it just here. So it's previous net PP&E plus annual capex minus annual depreciation. So what's wrong with that? It's plus. So here you go, 51, 103, 155. Seems that it's good now. So, and finally, what we have to do is to make a few assumptions for other line items that we will use on the balance sheet. But before that, I just want to insert 5 more, 1, 2, 3, 4, 5 more lines here. It will be very useful later when we will be creating our projections. Since we'll be projecting for 5 years, I'm making this just 5-row schedule on top of what we have. So it would be 18, it would be 19, it would be 2020, 2021, and 2022. Here we are. So our final table here of assumptions, it's other assumptions. So here you go, other assumptions. So we'll be assuming our new equity issued by the company. It will be long-term investments per year. It would be increase in non-current assets and increase in non-current liabilities, all in thousands of dollars. For now, we're just leaving it empty as we've done with previous sections. So we'll calculate those ratios and those metrics once we are able to fill in our historical balance sheet numbers. So let's move on to creating our income statement. Let's begin creating our income statement. So first, the top line is revenue. We'll be measuring it in thousands, and we'll calculate revenue growth as well here. It will be in percentages. So we've done that before, so we're just linking it to our income statement assumptions. 1 second. Here you go. It's just a 5. Yeah, that's simple. So for the first year it's not available, then it's straightforward. So we've calculated the revenue growth. Super. What's going next is, of course, cost of goods sold. So costs of goods sold. So it will be in thousands of dollars. And frankly speaking, we've calculated that as well. So we just know to link that. So it's 4K, 450, 479, and 562. So now let's calculate our gross profit. It's simply revenue minus cost of goods sold. So here we are, and calculated, of course, our gross margin. It's gross profit divided by revenue. So 78, 79, 80, pretty solid gross margin. And as we are operating in technology business, it could be the case. It could be the case. So next we are moving to operating expenses. So operating expenses. As we've done it before, and as we've done our assumptions, it's research and development expense, it's sales and marketing expense, it's general and administrative expense, and it's depreciation and amortization. Everything in thousands. Here we go. Here we will sum this up. It will be the total operating expenses. Here you go. Again, I'm using my Mac, so I'll have to make the border manually, but in Windows it's just a pretty simple shortcut that allows to do that. Okay, so let's just link from what we created. So, our research and development. Here you go. So linking it, making sure it's properly linked. So sales and marketing expense. Again, we calculated that already. So sales and marketing expense. Here you go. Then what we have is general and administrative expense. So here we skip that, so we'll have to just add this up. Okay, and now linking it correctly to our income statement. So here you go, general administrative, making sure it's properly linked. And our depreciation amortization, we are taking it exactly from our schedule that we calculated. So let's do it. Here you go. What's wrong with it? So it's 990.30. So it seems that it's all correct. And obviously it's just the sum. Okay. So here you go. So now we are able to calculate finally our EBIT, or our operating income. So operating income, or EBIT, measuring it in thousands. Alright, so it's gross profit minus total operating expenses. So at this point we are looking to figure out what is our EBIT margin, or operating income margin. So operating income EBIT margin, simply operating margin. So it will be in percentages. It's obviously operating income divided by revenue. Here we go. Yeah, pretty solid. So now let's calculate our EBITDA. As we are, it will be in thousands. As we are making all this very simple, we will not assume some like complicated adjustments, and we will just take our EBIT and add back depreciation and amortization. Here you go, and let's take EBITDA margin as well here. So it will be in percentages, Very simple. It's EBITDA divided by revenue. So 33% EBITDA margin, gradually increasing over time. So once we've done with that, we have to calculate interest, income, and expense. So let's make it double here. 1 second. So here you go. Interest, income, and expense. So it would be as well in thousands. And let's leave it blank for here for now, since it is dependent on our cash balance and debt balance. So we will assume that the company has zero debt, because it's a startup, and for the startup it's extremely difficult to raise debt financing, so it's just only equity financing here, so no debt. But the company will be still earning some interest on cash, and you remember we've done this assumption for the interest. It earns 4% on cash, but since we don't have the cash balance yet, we are not properly able to calculate that. So all right, let's apply some formatting here. Okay, so for now, leaving it empty and calculating profit before taxes. It will be in thousands of dollars. Okay, so obviously it's operating income plus interest, income, and expense. So here you go. Then we are calculating our income tax and making a sanity check by calculating effective tax rate here. So income tax will be measured in thousands. Really straightforward. We're taking our profit before taxes and multiplying it by our effective tax rate assumption. So here you go. We've calculated that. So effective tax rate, simply dividing income tax by profit before taxes. So here you go, our effective tax rate. And finally, we are able to calculate our net income, measuring it in thousands, and it's obviously our profit before taxes minus income tax, so it's there the numbers, and calculating net income margin in percentages by dividing net income by revenue. So it's pretty solid net income margin. 26% in the first year and 33% in the third year. Whoa, that's perfect. So that's all for the income statement, and let's move on to the balance sheet. So after we created our income statement, let's move on to the balance sheet. So first we will begin with assets. Here you go, assets. And we will divide those assets into current assets and non-current assets. So let's begin with current assets. Here you go. It's first of all cash and cash equivalents. Then it's accounts receivable, Let's move on to prepaid expenses, inventory. So here we have total current assets. Here you go. So all measuring in thousands of dollars. Here highlighting in bold. Okay. So we will leave our cash and cash equivalents row empty, since we will have to link it to our cash flow statement so that our balance sheet balances. As for these three rows, we are going to insert actual historical numbers. So let's assume it's 160, 200, 240, here you go, prepaid expenses 45, 60, and 73, inventory 77, 100, and 113. So let's calculate total current assets. So I'll have to make the border very uncomfortable to make it by using your mouse in using the Excel Mac. So our total current assets, it's just the sum of those three. Here you go. Then we have our non-current assets. Okay, here you go. So non-current assets. So obviously it's property, plant, and equipment. Net, of course, net of depreciation. Then it's a long-term investments. 1 second here, and other non-current assets. Here you go, and of course we have here total non-current assets. I will copy the formatting, Ctrl C, Ctrl Alt V T. Here you go. So property, plants, and equipment, very easy. All measuring in thousands, of course. So the border is correct now. So all measuring in thousands. Okay. So property, plants, and equipment. We are just linking to our schedule that we created. So total PP&E net. All right, 51, 103, and 155. Seems that it's correct. So for long-term investments, let's insert our assumptions. So let's make it like 0, 0, 0, because it's just a startup. You don't want to make any like long-term investments. You're just using you're generating cash and using your cash in your core business operations. So no long-term investments so far. As for the other non-current assets, let's assume it's just 1, 2, 2 here. Okay, so total non-current assets would be basically the sum of those three. So we have 52, 105, and 100. Okay, so we have our total assets here, measuring in thousands. Here you go. So it's just the sum of total non-current assets plus total current assets. So here you go. After the assets, we have this section called liabilities plus shareholders' equity. So liabilities and shareholders' equity. And let's begin with current liabilities. So it's accounts payable, line item, it's accrued expenses, line item, and deferred revenue. And here we have total current liabilities. So all measuring in thousands. So I'll copy the formatting here. Control T. Okay. So accounts payable. Okay, just if you're okay, so just inserting the values right here. So it's 9, let's assume 17, 28, or any other numbers you have in your historical financials. So 9, 70, 28, and deferred revenue, it's 20, 22, let's assume it's 31. So total current liabilities is just the sum of these three items. Super. So we have also non-current liabilities. Since we're assuming that our company has no debt, so obviously we will not include this line item here. So we have no debt. So let's make it other non-current liabilities. Measuring in thousands. Okay, so here we have total non-current liabilities. Here you go. Copying the formatting. Control C, Control Alt V, Control Alt V T. So Control C, Control Alt V T. So here you go. So let's assume we have 1,000. So it's just this number. Super. So now we can calculate our total liabilities. Let's do that. So it would be in thousands. Okay, it's total non-current liabilities plus total current liabilities. Here you go. Super. And let's move on to shareholders' equity. For simplicity, let's leave just two line items here. First of all, it's common stock and additional paid-in capital, or common stock and EBIT, and retained earnings. Again, measuring in thousands. Here we are. So let's assume that once you've incorporated your startup, you just had $150,000 or any number you want. So I will insert here $150,000, and it will be our assumption here. So we will have to make it formatted like here. Here you go. So obviously, and we've never raised any financing so anymore. So our common stock and EBIT remains the same. So and these common stock and EBIT first came to our cash. So in the beginning of the period, we've transferred our investment in common stock and EBIT into our cash balance. So here you go. Let's make it equal. Okay, so our common stock and EBIT balance here, we can collapse it here right now. And we are leaving our retained earnings balance empty for now as well, because no, we can basically we can make it. We can make it, since we do have already our interest, our income statement ready. So it's basically equals previous retained earnings balance plus our net income for the period minus dividends. But here we assume that we have no dividends. So super. We have our retained earnings balance here. Okay. So we are collapsing our beginning 15 period here. Super. So total shareholders equity in thousands. Copying the formatting, Control C, Control Alt VT. Here you go. It's just the sum of these two numbers. And of course, what we need to do is to make our sanity check. So the balance sheet is complete when our total assets equal total liabilities plus shareholders' equity. Let's do that now. First of all, let's calculate total liabilities and shareholders' equity. Again, thousands. So very simple. Taking our total shareholders' equity and our total liabilities. Here you go. Very simple. And making our balance check. So we are looking to subtract our total liabilities and shareholder equity from subtract total assets from our total liabilities and shareholder equity. Of course, it's now not in balance because we have the two. We have one line item empty, and it's cash and cash equivalents. So we will be able to balance it once we have our cash flow statement ready. So of course, for now, our balance sheet is not in balance because we have one line item empty. It's obviously cash and cash equivalents. So we'll be able to balance our balance sheet when we have our cash flow statement ready. So let's proceed to that. Once we have our balance sheet ready, what we need is to create the cash flow statement and finally make our statements, three statements, link with each other. So let's begin with cash flow statement, and the first section is cash flow from operating activities. So cash flow from operating activities. It begins with net income. Then we have adjustments for non-cash charges. Then obviously in our model it's just depreciation and amortization. Then we have changes in operating assets and liabilities section. We already discussed that. Those are 6 items, very important for modeling and obviously very important for DCF modeling. So it's account receivable line item, prepaid expenses, and inventory on the asset side. On the liability side, those are accounts payable, accrued expenses, and deferred revenue. Here are, and finally we're able to calculate net change in operating activities. So I'll copy the formatting. And now we need to take units. Okay. So units are in place. 1 second. So now units are in place. Let's make the numbering here. There's a bold. Okay. All right. So let's begin with net income. Just linking it to our income statement. Here you go. Net income. Then adjustment for non-cash charges. It's depreciation and amortization. Easy. Just linking again to our schedule that we've built previously. So our annual depreciation and amortization. Super. Then accounts receivable. So for these operational items, there is the rule of thumb. So if assets increase, it means that consume our cash. So it will mean that our cash flow goes down. But if liabilities increase, it means that we are getting our cash. So if, for example, accrued expenses increase, over time, we are increasing our cash. So super, let's do that. Let's expand our hidden item and just link that to the balance sheet. So accounts receivable. Very easy. Let's find this item minus the previous number. Okay. So, and to reflect that the increase is actually decreasing our cash, we are multiplying it by -1. So here you go, 160 minus 40 minus 40. Seems to be true. The same thing with prepaid expenses. Okay, and inventory. So you see here they are exactly the same composition of the structure of the section, so we just can copy that across and it would be calculated correctly. So here you go. Yes. So for accounts payable, let's go to our balance sheet and liability side. So accounts payable, accrued expenses, deferred revenue. Accounts payable, accrued expenses, deferred revenue. So exactly the same. So we don't have to revert anymore, just copying that. 9, 8, 11, Yeah, seems that it's fine. So, and to calculate the net change in operating activities, we just need to take the sum of those items and add our depreciation and amortization and add our net income. So here you go. It seems to be fine. So the next section is our cash flow from investing activities. In our model, we are keeping it simple, so we have only purchases of B, P, and E, or property, plants, and equipment, or capex, capital expenditure investments. And other investing activities. So here we go, we're measuring it in thousands. Very simple. So for purchases of PP&E or capex, we're just going to our capex section of the schedule. So look, here we are, we copied that across, but there is one important thing. If we are investing in capex, we are spending our cash. To reflect that, we just need to multiply it by -1 to reflect that obviously it's a cash outflow. So for other investment activities, so same thing here. We need to go to other non-current assets, take this delta and multiply it by -1. Here you go. -1, -1, and 0. Alright, seems to be true. Then we have net cash in investing activities. So measuring it in thousands, I'm copying the formatting here. Ctrl-Alt-V-T. Here you go, sum. So here you are. And our final section of the cash flow statement is cash flow from financing activities. Again, keep it simple, we have only two items here in our model. It's new equity issued by the company and other financing activities. Okay, in thousands, measuring in thousands. Here are just change in our common stock and epic. Obviously 0. And change in our other financing activities, other non-current liabilities. So it's 1, 0, 0. Okay. And finally, we're calculating our net cash in financing activities. Copying the... So first of all, measuring in thousands, copying the formatting. Here you go. It's just the sum of those things. So finally, there is net change in cash. This is what we were looking for. Finally, to figure out what would be our net change in cash for the period. Very simple. It's net change in operating activities, net change in investing activities, and net change in financing activities. Here you go. So once we have our net change in cash, we can finally go to our balance sheet and make our cash and cash equivalents row perfectly balance our balance sheet. So what we do is we are taking previous cash and cash equivalents balance and adding the net change in cash that we've just calculated. So here you go. This is all cash. And one more thing on top. You remember when we were building our income statement, we left our interest, income, and expense row empty because we didn't know what the cash was, what our cash balance was. So now it's simple. We can just calculate that once we know our cash balance. So we are going to our income, interest, income, and expense, and taking the cash from the previous period and multiply it by our assumptions on interest on cash. So basically we'll have to, more precise would be averaging that, but let's leave it as simple as it is. So we have our new numbers of profit before tax, new income tax number, new net income numbers, and finally we will have our balance sheet perfectly balanced. Now we have our operating model ready. We've calculated our income statement assumptions and built the income statement. Further, we've made our balance sheet assumptions and created our balance sheet. And finally, we've made the cash flow statement that is balancing both sides of the balance sheet and makes our statements link together. So next we'll be creating our future projections.